Welcome to our channel, where we unravel the mysteries of the financial world. Today, we're diving into a topic that often entices beginners, but also raises some eyebrows: speculative investments. Whether you're new to investing or looking to expand your portfolio, join us as we explore the thrilling highs and cautionary tales of speculative investments for beginners. Investing is a journey that offers the potential for financial growth and security, but not all paths within this realm are created equal. Among the myriad investment options, speculative investments stand out as a distinct and often alluring choice for many beginners. Speculative investments involve a degree of uncertainty and risk, offering the promise of substantial returns, but also the potential for significant losses. In this video, we will delve into the world of speculative investments, explore their appeal to beginners, highlight key examples, and provide essential insights for those venturing into these risky waters. The tempting allure. Speculative investments often captivate beginners due to their promise of sky-high returns within a relatively short period. The allure of striking it rich quickly can be difficult to resist, especially for those new to the investment landscape. In a world where stories of overnight millionaires seem to abound, speculative investments can appear as a shortcut to financial success. However, this very allure is what makes them inherently dangerous. The spectrum of speculation. Speculative investments encompass a wide range of assets, each carrying a distinct level of risk. From cryptocurrency and penny stocks to commodities and high-yield bonds, the spectrum of speculative investments is vast and varied. Cryptocurrencies like Bitcoin and Ethereum, for instance, have witnessed astronomical gains in recent years, attracting hordes of novice investors. Similarly, penny stocks, often associated with small companies and traded at low prices, can experience explosive growth, albeit with an equally significant potential for losses. Navigating the risks. For beginners, speculative investments demand a cautious approach and thorough understanding of the associated risks. One primary challenge lies in the volatility of these assets. Prices can swing dramatically in a short span, driven by market sentiment, news, or technological developments. Additionally, the lack of regulation in some speculative sectors can expose investors to fraud and manipulation. As a result, conducting thorough research and consulting financial experts is crucial before allocating funds to speculative ventures. The role of diversification. Diversification, a fundamental principle of investing, becomes even more critical when dealing with speculative investments. Spreading investments across various assets can help mitigate the risks associated with any single investment. Beginners should resist the temptation to put all their eggs in one speculative basket, as a significant loss in such scenarios can have severe financial repercussions. Learning from the pros. While speculative investments come with risks, they also offer valuable lessons for beginners. They teach the importance of patience, due diligence, and understanding market trends. Successful speculative investors often have a deep understanding of the assets they choose to invest in and a keen ability to read market dynamics. By learning from their strategies, beginners can acquire essential skills that can benefit them in all forms of investing. Speculative investments can hold a tantalizing appeal for beginners, promising quick riches in a dynamic and ever-changing financial landscape. However, the allure of substantial gains is accompanied by equally substantial risks. As beginners embark on their investment journey, it is vital to approach speculative investments with caution, conduct thorough research, and seek advice from seasoned professionals. While speculative investments may offer enticing opportunities, they require a solid foundation of knowledge, a keen understanding of risk management, and a commitment to continuous learning. Remember, in the world of investments, knowledge and prudence are your most valuable assets. What is speculation? In the world of finance, speculation or speculative trading refers to the act of conducting a financial transaction that has substantial risk of losing value, but also holds the expectation of a significant gain or other major value. With speculation, the risk of loss is more than offset by the possibility of a substantial gain or other recompense. An investor who purchases a speculative investment is likely focused on price fluctuations. While the risk associated with the investment is high, the investor is typically more concerned about generating a profit based on market value changes for that investment than on long-term investing. When speculative investing involves the purchase of a foreign currency, it is known as currency speculation. In this scenario, an investor buys a currency in an effort to later sell that currency at an appreciated rate, as opposed to an investor who buys a currency in order to pay for an import or finance a foreign investment. Without the prospect of substantial gains, there would be little motivation to engage in speculation. It may sometimes be difficult to distinguish between speculation and simple investment, forcing the market player to consider whether speculation or investment depends on factors that measure the nature of the asset, expected duration of the holding period, and or amount of leverage applied to the exposure. How does speculation work? For example, real estate can blur the line between investment and speculation when buying property with the intention of renting it out, while this would qualify as investing. Buying multiple condominiums with minimal down payments for the purpose of reselling them quickly at a profit would undoubtedly be regarded as speculation. Speculators can provide market liquidity and narrow the bid-ask spread, enabling producers to hedge price risk efficiently. Speculative short selling may also keep rampant bullishness in check and prevent the formation of asset price bubbles through betting against successful outcomes. Mutual funds and hedge funds often engage in speculation in the foreign exchange markets, as well as bond and stock markets. Speculation and the Forex market. Forex markets execute the world's highest total volume and dollar value, with an estimated $7.5 trillion per day changing hands between buyers and sellers. This market trades around the world for 24 hours a day, while positions can be taken and reversed in seconds, utilizing high-speed electronic trading platforms. Transactions typically feature spot deals to buy and sell currency pairs, such as EUR/USD, Euro/US dollar, for delivery through auctions or simple exchange. This market is dominated by asset managers and hedge funds with multi-billion-dollar portfolios. Speculation in the Forex markets can be hard to differentiate from typical hedging practices, which occur when a company or financial institution buys or sells a currency to hedge against market movements. For example, a sale of foreign currency related to a bond purchase can be deemed either a hedge of the bond's value or common speculation. These relationships can get complicated to define if the currency position is bought and sold multiple times while the fund owns the underlying bond. Speculation and the bond market. The global bond market is valued at over $133 trillion, of which approximately $51 trillion is based in the United States, and these assets may include debt issued by governments and multinational corporations. Asset prices can fluctuate greatly and are strongly influenced by interest rate movement, as well as political and economic uncertainties. The largest single world market trades U.S. Treasuries, with prices in that venue often driven by common speculation. Speculation equities. Speculative trading is a major part of the stock market, accounting for a significant portion of the daily trading volume. It usually involves buying and selling stocks to profit from short-term price fluctuations, rather than focusing on the long-term fundamental value of a company. This approach often relies on technical analysis, market trends, and real-time news to identify potential opportunities. While speculative trading in equities can offer significant profit potential, it also carries substantial risks due to market volatility and the unpredictable nature of price movements. Is speculative trading only for professionals? Speculative trading is not exclusively for professionals, but it does require a certain level of knowledge and experience to navigate effectively. Both amateurs and professional traders can engage in speculative trading, but it's essential to understand the risks involved and have a solid strategy in place. Before diving into speculative trading, it's crucial to educate yourself on market trends, technical analysis, and risk management. Always remember that speculative trading can be highly volatile, and it's essential to approach it with caution, regardless of your experience level. Is day trading considered speculation? Yes, day trading is considered a form of speculation. Day trading involves buying and selling financial instruments such as stocks, currencies, or commodities within the same trading day, with the aim of profiting from short-term price fluctuations. Day traders typically close all their positions before the market closes to avoid overnight risks. Since day trading focuses on short-term market movements rather than long-term fundamental value, it is considered speculative in nature. It's important to note that day trading carries significant risks and requires a high level of discipline, knowledge, and experience. Has there been an increase in speculative trading in recent years? Yes, there has been an increase in speculative trading in recent years. Several factors have contributed to this growth. Technology advancements. The rise of online trading platforms and mobile apps has made it easier and more accessible for individual investors to engage in speculative trading. Lower costs. Online brokerages have reduced trading costs, including commissions and fees, making it more affordable for individual investors to participate in speculative trading. Greater access to information. The internet and social media have made it easier for investors to access financial news, analysis, and opinions. The popularity of new asset classes. The emergence of cryptocurrencies and other alternative investments has attracted many speculators looking for high returns and unique opportunities. As you navigate the intricate realm of speculative investments, remember that knowledge is your best ally. Make sure to like and subscribe for more insightful content that empowers you to make informed financial decisions. Until next time, happy investing.